Swanand Kelkar joins us, managing partner with Breakout Capital Advisors. Can I guess from where this Breakout name has got inspiration?
Go for it.
I'm just guessing. I mean, Ruchir wrote a book.
That's right.
And maybe Breakout Nations, and that inspired you, right?
That's right. That was the first book that he wrote, Breakout Nations, and the name is inspired from that book.
Not bad. Okay. How's it going?
Pretty good.
Yeah.
Pretty good.
What's keeping you busy these days?
So, as you know, the Breakout Capital Fund is an emerging markets long biased fund which invests across 35 best quality stocks across emerging markets, including India. And India, again, no points for guessing, is one of the largest allocations that we have.
So you invest in all emerging markets?
That's correct.
Okay. And in this kind of an environment where everybody is saying that emerging markets are more like a trade which you should avoid because of what is happening in United States, dollar strength, built America, complete change of narrative after return of Donald Trump. Is it a good idea to perhaps invest in an emerging market fund?
I think what you say is the consensus view out there, right? I mean, there are people who are saying that emerging markets is no longer an asset class because of multiple things that you just mentioned. But here are a few things, right? One, if you look at the valuations overall for emerging markets, if the US is trading at 22, we are at 20. Emerging markets as a whole will be at about 10, 11 PE, right? So the valuation starting point is very undemanding. And a couple of other interesting things have happened, that the fiscal excesses that you see in most of the developed world, you don't see them in most emerging markets, including India. We have had a budget which is on a consolidation path, which means that there is room for most emerging markets to embark on a cycle, be it on the private side or on the government side, where you can go for growth by embarking on a leveraging cycle. That's one. The second is the inflation experience in most emerging markets, again, has been much milder. Especially in Asia, than some of the developed markets, which means that currently, because of Fed and what you mentioned, most emerging markets are running fairly high real rates, right, where your actual interest rate is much higher than the inflation in the country, which again gives you room to cut when things become easier, right. So there is fiscal support possibly, there is monetary support possibly, valuations are undemanding. When this whole tariff, strong dollar, deglobalization narrative settles, I think on the other side of it, you will expect that some of the good companies in emerging markets will start outperforming.
For a top-down guy, the basic criteria for investing into emerging markets for the longest time has been fiscal deficit and the underlying GDP growth. India seems to be scoring at least on that front. Underlying growth is decent.
That's right.
It's not extraordinary, but it's decent.
That's
we are
right.
still above our mean.
That's right.
Which is 6%. And fiscal deficit, it's never been good.
Yes.
Yet, FIs are selling.
Yes.
Yet, rupee is weak. What am I missing on?
Excellent. So, the first thing I'll say is that I take exception to you calling me a macro investor, because I feel I'm as much a bottom-up investor as I'm a macro investor.
No, I'm saying macro investors. When macro investors invest in emerging markets.
But for equity investors across emerging markets, you look at generally 4 parameters on the macro side, right? You look at the 2 deficits. You look at the fiscal deficit, you look at the current account deficit, you look at inflation, and you look at growth, right? These are typically the 4 metrics that you broadly look at. And on none of these, as you rightly said, India is flashing any red signs. Current account deficit is in control, fiscal deficit is high but consolidating. Public debt, you can argue, is on the higher side when compared to emerging markets. Growth is reasonable, has come off, and inflation still not fully under control of RBI, whatever number you want, but it's still hovering in a 4-5 sort of a number. So on the macro side, I don't see any issues there. Coming to the $1 trillion question of why FIIs are selling, right? So the one simple answer, and I get to interact with this cohort quite a bit, these are the global asset allocators. So the one thing which has happened in the past 2-3 years is the rise of the US, right? So if you look at the US weight in some of the global equity indices, right, be it MSCI ACWI or MSCI World, that number is between 65 to 75%, somewhere there. So the only thing that matters for a global asset allocator on the equity side is to get the US call right. India, by the way, is 2% in MSCI ACWI.
Can you break that for our viewers? So I'm just going to simplify it for our viewers, just for non-sophisticated viewers will appreciate that. Out of the 100 rupees which is there in the total financial market, 65% is in US.
That's right. So if I am a global asset allocator, what does that mean? If I put money into multiple equity markets across the globe, the index against which I am measured, the weight is 65 to 70% US. Emerging markets all put together is 10%. India is 2%, Japan is 5%, right? So my entire focus is on US and getting the US allocation right. I go to these people, I tell them, okay, India, like great story, all these 4 banks looking great. They say, hey, nice, great, but you know what? My bread gets buttered when I get my US call, right? And that's where bulk of the money is going. Having said that, the couple of other things to keep in mind when you think about a FII view of India. One is that you have to contend with a rupee depreciation which is on trend 2-3%. That is not specific to India, that is true for most emerging markets. And plus, at the least, you are going to pay 12.5% of capital gains, right? So if let's say you are US and you are India, if you add up the currency and the tax impact, on day one, you have a handicap of 400 to 500 basis points.
Because of currency.
And taxation.
Yeah.
Right? Because of the,
add
both those things together. When your return is 25-30%, this 4% handicap doesn't matter, right? So as in cricket, when they say when you are making runs, nobody focuses on your technique. It's when you stop making runs that everybody says the elbow is not coming out, this, that and the other. Which is what's happening now, right? So this is part of creeping into the conversation saying that, hey, I am starting 400 basis points. If you're only going to produce 10-12%, might as well consider US treasuries as well, which are yielding 4.5-5%. This is an emerging conversation. It is happening at a point in time, which is now where, you know, the trailing returns, let's say for the last 6-12 months have come off. If we again go back to the 15-20% local currency returns number, I think these discussions will stop.
Okay. Could the collateral damage extend itself? Could the bad get worse before it gets better? Because things are stacked up so much in favor of US that any change could have a domino effect on currency, on emerging markets, even liquidity. So could it get really ugly? You know, they say that you could reach a stage of capitulation like you're reaching in mid and small cap stocks before the market bottoms out.
Absolutely. So it's very hard to time market bottoms, right? You have been here long enough, I have been here long enough to know that. But the direction of the trade, as you rightly pointed out, is so one-sided that just looking at it, I'm talking from an emerging market standpoint, just looking at how lopsided the whole thing is as a contrarian or some kind of a market cycle's history, you are tempted to make the other side of the trade. Now, what will cause this to rebalance again? I think the key fault line in the US, as people have said, and I agree with it, is the fiscal deficit. Right? You are still printing. The joke is, had US been an emerging market, it would have probably been at the doors of IMF. Asking for a bailout, right? But you have your own currency and people are more than willing to buy US treasuries, etc., which keeps the whole engine going. That's the fault line. That's to watch out for. I agree with you. The volatility is gut-wrenching. You're one tweet away from something new happening. We've been having this interview yesterday.
Tariff, today no tariff.
Exactly. I would have given you a long answer on how tariffs hurt both countries. But today it seems that we are off to the races.
You know, it amazes me that FIs are saying, "Arey, why are you selling? By tariff aa raha hai." I said, "India mein tariff nahi aa raha. Why are you selling India?" No. We are selling India. So let's look at the micro now. We looked at the macro.
Sure.
The macro is India is in a better place.
Yes.
Growth is not bad.
Yes.
And this one-sided trade will end one day. It could be 1 month, 2 months, 3 months. It may well be end of the year.
Could be.
We don't know. But that time is the time when you actually would see a serious reversal happen.
Absolutely.
And you have to plan for the trade to reverse. Rather than preempt when it will happen.
Absolutely.
That's a broad message
and
for
the only thing, the only thing I'll add is that standing here, you will not know exactly the chain of reasoning on why that trade has reversed. It will happen. The reasoning will be evident in hindsight.
Okay. Then I'll expand the basket of emerging markets.
Yes.
6 months ago, it was China over India.
Yes.
Has that trade died down?
So it's an interesting question, right? People think about China as, you know, this one thing which you are either positive or not positive on. But people forget the size of that economy, right? It is a $17-18 trillion economy which is growing in nominal terms at whatever 5-6%. It is very hard to have a structural positive view on China the way you have in India, and the reasons are well documented. It is the debt, it is the demographics, it is the deflation, which is kind of holding things back, right? The China which was growing in nominal terms at 15% is now growing at 5%. So it's very hard to say structurally I'm positive China, and yet there are pockets of opportunity, right? As a stocks investor, how do I make money? I make money by buying stocks. I don't make money by buying the Chinese index. And there are names there like a BYD, right, which is a global champion in electric cars. And in the past 5-6 years, you would notice that China has become an export champion. I mean, $1 trillion of surplus, despite the tariffs in Trump 1.0, despite the trends of deglobalization.
Tesla versus BYD. I mean, that great comparison is inevitable.
Absolutely. And plus you get stocks which have reasonable ROEs and yields which are pushing double digit in China, when the government yield in China is less than 2%. right? So we have a mix of yield plays and a mix of these global champions in our portfolio, which is again 7-8 stocks. We are not overweight China. I mean, we don't think in that construct because we are absolute return investors. But China versus India, to my mind, was never really a debate in the minds of the FII. The real debate is US versus EM, right?
Okay.
Am I going to be? So there was this narrative, if I remember 4 or 5 months ago, that people are selling India and buying China.
Yeah. October.
I
Just
couldn't
before
see
Diwali.
so in China it is very hard to get the flow numbers. We get it daily, but you can impute it from doing certain things. I didn't see a big flow number going into China either. So it's not like FI is after for 3 years saying that China is uninvestable. Have suddenly jumped in. There might be a few.
They say it's easy to get into China but difficult to get out.
The Hotel California analogy has been invoked multiple times, but that's not been our issue at all. I mean, we generally end up buying the Hong Kong listed shares. There are certain shares which have an embargo for US investors. They are sanctioned. But apart from that, I don't think there is an issue in terms of not being able to get out, at least on the public market side in the large cap names.
If you're going through the Hong Kong A shares, I would
That's
imagine.
right.
Okay.
A shares is the mainland, Hong Kong is the H shares.
Okay. Let's look at the micro.
Yes.
Raj, you are still the stock picker.
That's right.
लेने का,
हाँ.
ढूंढने का,
Yes.
मेहनत करने का,
Exactly.
फोन करने का,
Absolutely.
trends निकालने का.
Yes.
What are you buying? Where are you shopping?
Before that, what I will say is that after a long time, right, I feel that in India, the value of a fund manager is getting recognized. Right, it almost felt that for the past 3-4 years, you didn't need a fund manager. Right, if you look at the 4-year CAGR of large cap, it was 20%, mid cap 30%, buy anything, it was up. Right, and that's sort of, in fact, in my year-end note, I wrote that liability, so having experience in India was a liability. Because you have seen cycles,
Yes.
you have seen promoters,
Yes.
you have seen these things happen, you stay away from these stocks,
So true.
those go up. I think that's turning now, right? We are in a market where I think growth is slowing down, earnings growth is also slowing down. It is now important to stay close to the earnings growth trends rather than the narratives, right? You had multiple narrative stocks over the past 2-3 years, which you just have defense or you just have railways in the first slide of your presentation, you get a 50 PE. Right? You look at it later on what they are really doing there. I think that is all coming off. So first thing, I feel happy, not because there is any kind of a Schadenfreude there that I'm happy that markets are correcting, because I feel as a fund manager today, finally I have time to hopefully display some skill and generate alpha for my investors. I would say from a market standpoint, this is not a market where you should say that over the next 12 months I'm working with a beta of 20%, right? Where the market returns are going to be 20%, which has been the history of the past 4 odd years. And that's not something new. We have had single-digit Nifty returns, I think, for 5 out of the last 13 years, and that is the nature of this beast.
Last year also 8%, I think.
Yeah, even 2022 was a small number. 23 was big. 24 was barely double-digit. So where I'm picking stocks, I'm not hoping for a market return which is gangbusters. I'm not looking for any PE re-rating, right? Having said that, under that construct, what are the sectors that I like? I like consumer discretionary as a space. In fact, even the budget gives a push to that.
Consumer discretionary again, very
Autos.
simple. Autos.
Autos is largely consumer discretionary. There are a few EMS and consumer durable names. Those also look good. I count real estate as consumer discretionary. It might be a separate sector altogether, but all the macro factors that make you buy a car also make you buy a house.
But housing is like investment of your lifetime.
Yes.
Buying a car or buying a toaster is additional cash which you save, you buy.
Yes.
But why would you call real estate as consumer discretionary?
So what are the factors that help a consumer discretionary name? And let's include real estate in that basket. Your income has gone up in your hands and you feel reasonably good about your income prospects, right? That's when you're going out and doing a bit of shopping. Otherwise, the Chinese example, right? If you give a Chinese consumer the kind of tax break that we have given, they will save all of it, right? Which is called as the paradox of thrift. That you get the money, it's saved or delevered, you don't spend
This is India of 1990s.
Exactly.
Whatever you got, you saved it.
Exactly. So in that case, such a stimulus or such a tax cut won't work at all. That's the last thing the Chinese government should do. Coming back, I think the prospect of rate cuts, right, rates getting easier, right, which is I think on the anvil. I don't know what happens on Friday, but hopefully over the next few months and quarters, that's the direction that we are traveling in, right? So the fiscal has given you a boost. The monetary policy will hopefully be supportive. You will have some sort of pay revisions which happen for the government employees in FY27. All these things put together, I think help things where you are buying discretionary. Buying a house is aspiration. I understand people don't make a house buying decision just because rates have been cut 25 basis points. But these are long cycles. I mean, almost nothing happened for 7-8 years in terms of the real estate market in the most part of last decade. That is now looking up.
Okay. Well, so the theme is perhaps, I mean, we've been saying this on air, I think from Saturday, that 2021, if you bet, you started buying into build India stocks, defense, infra,
Yes.
railway, you made money.
Yes.
Now is it time to switch and say, buy consumer India stocks?
It's a great question. So I used to have this chart in one of the decks that we used to have, which was the Larsen versus Hindustan Lever chart, right? And if you look at the 2000s, right, it was a lost decade for Hindustan Lever. Nothing happened, and Larsen was, go-go. That decade from 2010, I'm giving you broad numbers. From decade from 2010 to 2020, it was all about lever, and Larsen was probably going sideways. That reversed, as you rightly said, something in 2021, 22. Is it time to reverse that trade? My answer is no. Is it time to get a bit more nuanced about that trade? The answer is yes.
So it's time to reduce exposure to Larsen and increase exposure to HUL, but don't flip.
Larsen types, HUL types.
Okay, of course. Just putting
and I'll give you the logic behind this, right? So what is
why do you say Larsen types and HUL types? Why not Larsen and HUL?
Sure, Larsen and HUL per se. I wouldn't own HUL today at all, but which is why I said HUL types. So the logic on Larsen is simple, right? Everybody's getting worried that Capex growth is 10%, which is the end of the public Capex story, so to speak, and now there are freebies being given out. So again, if you look at numbers, the revenue expenditure growth is 7%, and if you take out interest from there, it is 4%. And capital expenditure is still growing double digit in line with nominal GDP. If you add the states, which are important parts of capital spending, that is still a reasonably good number. What happens is when some of the stocks that you mentioned, the defense, the railway, and this, that, and the other, that gets bid up to 80, 90, 100 P, what matters is not growth. What matters is the rate of growth or the second derivative of growth. So when a 25% Capex growth at the center comes to 10%, the stocks derate. You don't want to be...
Just say that again.
So when the second derivative of growth, right, which means the rate at which growth is happening.
Okay.
So let's say all through F21 to F24, public Capex growth, the CAGR would be 20%.
Yes.
Right?
Yes.
In FY25, that number will be maybe double digit. In next year also, it will be double digit. So the rate of growth has slowed down, which is fine. It is not fine if you have paid for an accelerating growth into perpetuity. If you have paid 80 PE for that stock, that basically means that the deceleration in growth is bad for you because you have, in your DCF or in whatever modeling you do, you have put a 25-30% number into perpetuity.
In PSU actually happened like this. 8 became 80.
Correct.
2000, the P multiples were single digit.
Absolutely.
Then it almost were nearing triple digit before this entire re-rating happened.
Which is what I mean by narrative stocks.
These are narrative. Where else do you think narratives are there in the market where we'll be taught an ugly lesson?
I don't know taught an ugly lesson, but I'll give you a broad construct of where narratives goes wrong, right? A narrative goes wrong when growth decelerates, right? Growth need not go to zero, right? If the rate of growth last year versus this year, if this year is lower, the narrative stock will get tossed, right? And that is where the sort of the rubber meets the road, as they speak. Railways, defense are seeing it. I'm not a big fan of consumer staples because it doesn't make sense of the volume growth versus the PE that I am paying for those names. I'm a big fan of a double-digit volume growth. Anything that shows a double-digit volume growth, I get excited by.
Okay. So, just last but one question. Let's divide the market into 2 or 3 parts. Where do you think markets are likely to be stumped on the positive side, whether it is growth or PE? And where do you think they would be disappointed on the downside? It could be earnings or it could be PE compression.
Excellent. So again, a slightly broader answer, right? There is a debate raging about whether this slowdown is structural or cyclical.
Okay.
Right? A structural slowdown means that we are on a
What happened to Japan?
Steadily trending down path. I think I'm very clear there that this is a cyclical slowdown, and it has been contributed by multiple factors: fiscal, monetary, monsoon, elections, whatever. I think growth comes back. Does it come back to 8%? Maybe not, but it comes back 50 basis points. So what it gives you is a business as usual sort of an environment. And a lot of people, I think, are in a camp where they think that this growth deceleration is permanent. I don't think so. In India, as a stock picker, what do you need? You need a double-digit nominal GDP growth, right? Uske baad you don't look at macro. 10-12% nominal growth hai, theek hai. What do I need to do? I need to pick stocks within this construct, which will grow 15%, 17%, 20%. Where do I think is there is not overheating, but there is too much excitement still? I would say in general, the mid and the small cap space, it still needs to needs to correct. If you look at the broad multiples, the large cap is still the cheapest. So the lower you go down the cap curve, the higher the multiple that you are paying. I think that is where still the risk is. Having said that, you do not discard that entire cohort altogether. Right? You will find areas in it. Right? I mean, the number
Where are you finding your areas there? Then?
So I'm looking at all these over the past 2-3 days, all the stocks which have been hammered because you think Capex growth in India is finished. Right? That's a good hunting ground that I'm looking at. I'm looking at banks. I'm looking at NBFCs as well, because you think this MFI / unsecured loan related credit issues are going to stay for the next 2, 3, 4 years.
Yeah. Oh, MFI could stay for 2, 3, 4 years?
That's the assumption.
Yeah. That's a market assumption.
That's the market assumptions, which is why some of these MFI companies, banks that have any sort of an MFI exposure, NBFCs that have any, they have gotten completely beaten down. Those are areas I'm evaluating. When markets are weak, all the capital market proxies that were darlings of the market 6 months ago, right? Everybody was willing to pay anything, even if you sold IPO forms on the street. Right? So I think those have all gotten corrected in a big way. I'm looking at those as well because I'm convinced that the equity culture of the country remains intact. The second derivative is slowing. So what happens when accelerating second derivative is you take the P to the moon, and when it comes off, you drop it big time.
But and just to wrap it up with one final question, another exciting space right now is the platform space. And they've demonstrated their ability to think in terms of profits, not think in terms of sky high. Yeah, exactly. So the TAM has become P now.
That's right.
Do you like those guys? Do you like those companies?
Selectively, yes.
Because you own Zomato.
That's right. And we have owned it for a while. So selectively, yes. So I'll tell you the logic on Zomato, right? I mean, we like the fact that on food delivery, this was becoming a duopoly. And this still is a duopoly. And duopolies make money in general, except if you're Airbus and Boeing. So Zomato and Swiggy both were making good money on food delivery. The platform companies, if you have been a consumer, they're very habit forming, right? So I feel that the growth runway is reasonably large, and the education that the public market investors have given these companies is that cash flows, earnings matter. This is no longer only about sales growth and GMV and TAM. And the people who have understood it have seen their stocks getting re-rated. The people that haven't are still languishing. So that's the broad answer to that. I like in general these platform companies. There will be competitive ebbs and flows, right? When something is growing 100%, it will be foolhardy not to expect a competitor to come and try and get a piece of that action. But my bet here is that the pie is growing so fast that even if the slice of the pie becomes smaller, there is still money to be made.
Well, we covered a range of topics, and so nice to connect with you, and so nice to talk about what we started with US. We discussed tariffs, we've discussed Zomato, we've discussed L&T. Only thing we've not discussed is perhaps yoga, and I promise we'll keep that for next time.
Love to do that. Thanks, Nikunj.
Thank you very much. Appreciate it. Good luck with your new venture, and thank you very much.
Thanks so much.
And you come here very often, I think. So let's, because to meet your distributors and to meet your clients, IFL, right?
Yeah.
So let's make sure that we also meet regularly here in the studio.
Let's do that.
Right. Thank you very much. Cheers.
Cheers.
Let's